Awesome. Yeah, me too. Let's get going. Life is good. Life is beautiful. So once again, good morning. Welcome. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or if you always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne. What's your name? I'm a currency trader. I've been doing this for a very long time. Hundreds of thousands of hours of just sitting here, watching the markets and trading and pulling the trigger and moving stops and looking at moving averages and pivot points. And wow. So I'm here to share the cumulative knowledge of all those blood, sweat, and tears for years, with the overriding goal of hoping that you can become a successful trader a little more quickly and without so much pain. Right? Without so much pain. So it's really good to have you here. I implore and even beg that you ask questions, because you are the boss and I am your humble servant. And you can tap into my brain and download all my experience. You just got to get involved. Otherwise, I'm just going to do technical and fundamental analysis the way I see fit. But you can lead and mold and shape the information we discussed today. Hey, we do these sessions 7:30 in the morning, New York time, which is approximately London lunch, here at Forex.Today, every Monday through Thursday. And then every Friday I'm at fxstreet.com for premium members. And at FX Street I am Forex Speaker of the Year. Oh, yeah. So thank you for your loyalty. And so what's on your mind so far? Any questions right off the bat? What about this? What about that? Well, write that down and document it. So let me go through just the morning report. Going to go through what's happened so far. Failed coup in Turkey. You know, the interesting thing about that is I saw it going down just as the markets are closing. I'm like, what? How dare you do that? Why would you wait for the markets to close? On Friday, it was just kind of like, oh no, there goes the lira. New Zealand CPI, did you get that? 1 year high. 1 year high. Very interesting. Hey, Jenna. So that's interesting. We've been watching the Kiwi as of late, and we've been watching dairy prices slowly stabilizing and almost actually kind of going up. And now we're seeing 1 year highs in New Zealand inflation. So maybe watching dairy prices is a good thing for the, when you're trading the New Zealand dollar. Chinese property prices have fallen in 10 out of 70 cities. Now, why wouldn't they just say prices have risen in 60 out of 70 cities? It sounds more impressive, doesn't it? Whatever. That's the funny thing about news, right? So Chinese new home prices month over month rise in 55 out of 70 cities. China existing home prices rise in 48, and flat in a bunch of other places. So in all 70 new home prices, all 70 cities, home prices have gone up for the 14th straight increase. Whatever. Looking at the markets, S&P 500 futures up just a little tiny bit. Euro stocks down tiny bit. Oil set to fall. It's already down about 1%. 10-year T-note paying 1.5 on the yield. Very, 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 very low, huh? DAX down, well, DAX is flat, FTSE up a quarter, Hang Seng up 3/4. Yeah. Looking over the dollar index, it's generally up, but caught on a weekly pivot point as resistance and holding that down. Copper has fallen a lot. Have you guys watched copper? Copper is significantly down from a monthly R1 on Friday, and we're all the way down to the weekly central pivot point on copper. Oil coming down hard, and gold probably going to want to do the same. Okay. So we'll see if risk off is going to continue or if the yens are going to move. So like one thing that I've been watching is like the beast. Let me switch over to a yen chart. We'll get going on that. Life is beautiful. So we'll see what's going on there. It seems to me I would mark this up like this for the time being, don't you think? Yeah, Charles wants to trade the Chilean peso, huh? Well, you know. So fairly quiet in the markets. It is the middle of summer. Drop it like it's hot. Oh, Miles wants to know copper. Okay, thank you very much, Miles. Why do I even follow copper or talk about copper? Copper is a leading indicator for macroeconomic growth. So if you need to lay down, internet lines and phone lines and pipes and in houses and it's just an industrial metal that is used for a lot of things. And if demand is increasing for copper, then the economies around the world must be expanding. Is the general idea. Okay. So I'm not using it specifically like if you think copper you could generalize and say copper comes from Chile. Well, copper comes from a lot more places than Chile, but that would be the standard operating procedure. But that's not what I'm using it for. I'm using it for risk on or risk off. So if generally around the world we're bullish on the economies in the United States and Europe and Asia, and we think they're going to expand and that kind of idea, then we want to, let's say, sell the yens and buy something. Okay. Typical risk on move. And if you think the global economies are going to expand, they're going to need natural resources and raw material in which that they'll expand, either to make products or just to build new buildings and so on and so forth, right? And copper is a nice metal to watch because gold is used for human mental emotional responses, but copper is copper, and it's used for electronics. It's used for piping. Like just think of hot water pipes. My house, my hot water pipes are copper, right? So um, it's used for stuff, and so if we're going to make more stuff, we're going to need more copper, and then therefore copper prices you'd think would go up. So yeah, copper up, probably commodity currencies up, funding currencies would weaken. So like maybe Japanese yen falls, maybe Swiss franc falls, that kind of stuff. John says, not so much anymore. Yeah, well, I still watch it. You know, it's not like I say, oh, look at copper, pff, all in, right, on a trade. No, but it's there. It's something to watch, right? Yeah, yeah. I'm not going to do Lyra today, Mike, but yeah, I'm sure there's plenty of nice opportunities in there. Right. So again, I'm trying to teach you how to be patient, disciplined, conservative traders looking for repeatable type of trading patterns that you could develop skills around. You know, jumping in and trading Turkish lira because of a failed coup. Hey, if you're skilled and you want the risk and you want to go in there and make a quick buck, great. It's probably not, you know, conservative and repeatable and all that kind of stuff, right? So, but you know, by all means, right? I'm not saying no. I'm just saying I'm not going to teach it in a webinar. That's all. So anyway, so that's where copper comes from. It's just a part of the tool chest per se, right? So one thing we should do is go through the calendar. Yeah, Moss, that's a nice way of saying it. Or you could say, wow, look at that. Commodities are coming down hard. I think I'll sell, you know, Aussie and CAD, for example, right? And you just look at it like, ooh, risk on, risk off, that type of stuff. Okay, so let's go through the calendar. Okay, so we got our Kiwi CPI. Okay, less than expected, but still better than before, right? So that's cool, right on. And then I guess it's tonight, we got the RBA meeting minutes coming out. Once again, I think you should download those and read them. Who's going to do that? Anybody? Who's going to? Yep. Anybody? Raise your hand and say I. I. Jenna? What happened to Jenna? Come on, Jenna. See, Mike. See. All right. Good. Good. And some of you guys may not even know what to look for. It doesn't matter. I don't even care. I just want to know that you did it. And actually read it and see what you see and circle things that you don't understand, and then maybe you could do research on that, right? But if you're going to be a professional, successful trader, I think you want to have those types of habits where you say, oh, I like to trade the Aussie. The Reserve Bank of Australia manages and influences the value of the Australian dollar based on their macroeconomic outlooks and the policies that they implement because of those outlooks. So I have an opportunity to download and read and find out what they're thinking and how they're interpreting the data. So they're trying to tell you what they're going to do. Anyways, you download it because you like to trade the Aussie dollar. That's it. That's the type of trader you are. Okay. So Joseph, you have decades to develop your skills in analyzing the RBA meeting minutes. Okay. I'm just trying, you know, so you can go in and get a PhD in economics by then. Right? Think about it, guys. Right? I'm in school now. I'm a college student. You could start economics 101 and within 10 years have a PhD. You could start today, go to school this September, and in 10 years you'll have a PhD in economics, and you'll know more about economics than almost everybody on this planet. That's it. In less than 10 years. Now, if you're 80, that's going to be a problem. But if you're 30 or 40, what the hell is stopping you, right? So anyways, you know, what do you look for, as Joseph says? You know, I don't know, just you'll get it. And like I said, read it, and then I would circle things that I don't understand, and then I would write that down on a list and maybe start Googling and just start figuring out, oh, well, that's interesting, and just slowly get involved, right? Just it's a beginning, but most of it's pretty clear. You know, they think the economy has external risks. That means basically China is not buying commodities from them, and they're worried about, you know, with interest rates being low, that there's going to be a housing bubble, and you know, and you'll start to. Most of it should make common sense. Okay. Anyways. Okay. And then on Tuesday, pound, 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 pound. What if you start trading today, trade the pound, and you get a trade at break even, and you let it run until tomorrow? You call that front running. So wouldn't it be nice if you went into tomorrow's pound news with a good trade on in the direction that you would like to be, just based on your bias? No risk in the market anymore because your stop is at break even. Let's say you're short British pound, and tomorrow PPI and CPI come out, and let's say it's no good, and you're already short pound. Boom, you'll pick up an extra 50 to 100 pips. That's one way of trading it, front run. So get in your pound trade today and jam your stop. Okay. We'll probably look at that a little bit later. Okay. And then what? German zoo. You know, all right, fine, but I don't think it's going to move the market. Housing starts, building permits of the United States. Again, not really a big deal, right? The trend is fine. Right now, it's not necessarily building houses. It's, you know, in the middle of summer, you're looking at existing home sales, even more than new home sales. And the numbers are usually better in the summer because families need to buy a house, you close on the mortgage, move into the house, all before school starts. Okay.
Minis at 21.59, looking to add to last week's gains and hitting fresh all-time highs like once again. The market gets underway for trade in about 90 minutes time. A little bit more mixed reaction to early trade in Europe. The FTSE and the DAX are in the green, but ever so slightly, while the CAC and the Euro stocks are marginally lower. The Nikkei finished up about 0.75%, and the Hang Seng added about 0.6%. The Shanghai was down 0.3%. Australian stocks were up about 0.5%. It has been a relatively quiet session, and over the weekend, outside of the news from Turkey, the coup attempt that broke late on at the coming to the end of the U.S. trading session on Friday has garnered much of the attention. We also saw some M&A. SoftBank said to be nearing agreement to buy ARM Holdings in a good-sized deal. ARMH trading notably higher and could help the tech space overall as when trade gets underway in New York. Just note the PBOC set the midpoint in the yuan at 6.6961. This is the weakest yuan setting going back to October of 2010, and it was the first weaker yuan setting in 4 days, so that theme continues. Fixed income markets, U.S. and European fixed income markets in particular rebounding a little bit after the dropping they took late last week. Yields in the UK, France, Germany all lower, while the US 10-year at 1.57%, trying to consolidate the move up we saw late last week towards 1.6%. The 10-year note future 132.02, the high was 132.04 half, while the Boon trading at 166.47, only 3 ticks off session highs in the 10-year Boon future. We just heard from Bank of America in the last half hour or so on their earnings report. Bank of America shares are trading modestly lower, down about 10 cents at 13.56. Oil prices are down about 0.75%, 45.60. The low was 45.50 for WTI. Brent trading down about 0.8%. Gasoline futures down 1.5%. $1.40 now in U.S. gasoline futures. In terms of currencies, cable up about 60 pips on the day in the middle of the range, 132.47. We did see the comeback in the British pound throughout late last week. That was after the Bank of America surprised markets by leaving rates on hold, but they did hint at a likely action in August.
That's just the ramblings of Trade the News in the background. All right. So on Thursday, pound, 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 pound. Yeah. Could be interesting. Now, are you buying pound or are you selling it? Yeah, just want to make sure. And why is that? Brexit is well long and gone. I mean, because of Brexit, it's fallen 2,000 pips, or okay, fine, good. Now what? Well, Carney said that the Bank of England was going to need to do something this summer, and he didn't do anything in July. The next meeting's August. So, just making sure we're all on the same page. So, anyways, more pound news. Retail sales is a big deal, right? Just as a sentiment index, but also it does lead towards GDP. The ECB needs to make a decision on their interest rates. That's cool, right? Now, does the ECB do things in July? Does it ever, probably not, right? Right. So I wonder if they're going to kick it on down the line. But Europe is in some pretty serious trouble and faces some pretty serious risks. So you'd think they would do something, but don't be surprised if they don't. But anyways, that's ECB. Great. And so that's going to take up that whole morning, right? Because that's actually that's right at 8:30. So that's going to suck up any volume and volatility. Anything right after that's probably just not going to matter that much, right? Am I reading this right? They're going to delay to the press. Okay, that's fine. So that's Thursday. Get your pound trade on early. Later in the day, or the New York session will be dominated by the ECB news. Great. And I guess we just go right on to Friday, right? Did we skip anything? Oh yeah, there's just nothing going on Wednesday. Yeah. All right. And then Friday. Nothing. So we got CAD, CPI, right? So that's cool. So, Friday, CAD days, Friday is CAD day. Of course, Wednesday with oil inventories and stuff. I've been sitting in the chair too long. Hey, did anyone do the rig count? I forgot to do the rig count on Friday. My bad. Baker, Hughes, rig count. Let's get that. Boom, boom, boom. Is it up? Thank you, Sally. 7. Wow. 14 on Canada. Oh, whoa, hey now. Wow, that's crazy, huh? So we're at 447. 1 year ago, though, we had 400 more rigs going than right now. So we're at the what, roughly we just passed the halfway mark, but still, the trend is up, right? Yeah, Dan, you'd think if there was 7 more rigs pumping oil that those, that would increase supply, wouldn't it? So that would be the idea. Life is beautiful. You gotta give it what you got. Gotta get. Uh, 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 uh. Yeah, nice. I love how they just every time I do this. I don't know. I must be a simple man. Be a simple kind of. I'm always looking for just like give me a chart. Just show me the chart. They never charted this. Anyways. All right. Well, so that's that. Fairly quiet week, right? We're going to trade the pound, then we're going to trade the euro, and we're going to end up the week with the kitty cat. So, pick your marks. Marina, are you buying pound or selling it? Mm-hmm. Buy it for a week or two and then sell it? Because, sometimes it's counterintuitive. People were selling the pound because they thought the Bank of England was going to do something in July. They didn't do. So there's a lot of people on the wrong side of that that are trying to get, the mentality, get back to break even. They're trying to get back to break even. And then, yeah, well, congrats. Yeah, so the pound gets strong for a while and then you sell it closer to the August meeting. So let's start, let's start with this. Mm-mm-mm, mm-mm-mm. La, la, la. And yeah, the interesting thing with this is at the Asian Open. Oh, let me get my drawing tool going. Oh, there it is. Pause. All right. Yeah, on the Asian Open, I was looking at this. Doesn't look like much, but it opened 50 pips off the line, and I thought, it'll go up first and then down. And yeah, but it hasn't really actually done anything. Okay. But if you were a bearer on this pair, which means buying Japanese yen, this is your weekly trade plan, right? Right? Who's new here? There's a couple of people that are fairly new. Anybody new? New. Shug, you're not new. Yeah, so anyways, there we go. So what happened to the people that came in and said, "Hey, good morning, everybody. I'm brand new." There was like one or two people that said that. Are they gone already? They're like, "Oh wow, this is lame." Really? Yeah. Don't judge me. So, anyways, there's the pattern that I was thinking about, and then there's Shiny Boy. Yeah, just observing them. How long have you been trading? Oh, right on, Sean. Yeah, good to have you. Mike- Mikey. Yeah, cool. Well, yeah. Glad you found your home. Some people have been here for many years. So it's not just a home, but it's a family. So, anyways, so I was looking at that, and then I thought but I got so many thoughts here. It's hard to throw them out. All right. So, anyways, that's where a bull would buy, right? So I thought, maybe I could sell into that. And then the opposite to maybe hedge, I was thinking Kiwi. And the funny thing, though, is at the Asian Open, we were up here. And I avoided that. But if you were a bull, what you're thinking of doing is buying in here, right? And you would probably watch the midpoint psych level, which is about here, kind of important. And then if you wanted, you could do like a little 1, 2, 3. And now we're in a roll reversal on this move. And your target is actually going to be a little higher than M4. But we have a cluster up there, right? So that's probably your target. Oops, just 78. Anybody got the same idea? Yeah, you got that, Daniel? Cool. Did you trade it? So just kind of based on the part of the world I live in, I looked at this and said, well, that's not really what I'm going for. I mean, I had the choice of buying it at the central, but I'm like, that's not really what I'm going for. And I guess down in here would have been better, but it was just not convenient for me. And it never really got down to that pivot. So, it's one of those things. Like it wasn't the greatest open for me. Okay. But if you were a bear now, you could have shorted that fairly easily. So my thought, as far as the hedge, I think I was trying to indicate, I thought it would be interesting if, let's say, you sold USD yen, and then, which means you're buying Japanese yen, and then the hedge it, you go long Kiwi yen. One of them's going to be right, right? So have you thought about, for example, let's say you longed, let's say you long 4 Japanese yen pairs of all the highest yield, so between 1 and 2% yield on each. So let's say you're averaging 1.5% amongst the 5 pairs, right? Okay. Are you using leverage? Probably, right? Some of you are using 500 to 1 if you're ultra conservative, 100 to 1. But what if you used ultra conservative, meaning like your lot sizes are really, really small? What if you're only using 10 to 1? That means you're clearing 15%. 15% is probably a pretty good return, right? But where are you going to get a bond that pays 15%, right? It'd have to be junk status, which is pretty risky. So let's say you did that and you're long these pairs. When do you get paid interest? Daily, right? So here's the interesting thing. What if you build yourself a portfolio where you're making 15, but of course if you're leveraging 100 to 1, that could be 150%. Okay? So anyways, you build a portfolio, you're long a bunch of yen pairs, and maybe you got, you know, you need to pick the highest yielders possible, right? So an Aussie and a Kiwi, for example. Okay, great. So now you're doing that. But the thing is, now you can, on days when the Japanese yen looks like it's going to be strong, so on days when the yen pairs are falling down, you have another account, just to make it easier. You have another account open, so you have a second TradersWay account, and that one only buys yen. See, your first TradersWay account only sells yen. So it's your Japanese yen ultra short fund, which I was talking about last week, right? Okay, good. So that means you're only buying Japanese yen pairs and it's collecting yield. Great. But on days when the Japanese yen is strong and the yen pairs are falling, you're in your second account, which is your hedging account. And you buy Japanese yen, but you close it before the end of the day. They're only day trades. And you only buy Japanese yen. Do you pay interest if you close the trade before the end of the day? So, in theory, on days the Japanese yen is falling, you're not making pips, but you're not losing pips either, right? Do you make any money? Yeah, you get your interest rate payment. Remember, as long as you don't lose pips, as long as you're hedging, you're going to make, let's say, depending on the combination of all the yields and your yield basket that you get and how much kiwi you have and all that kind of stuff. But let's say you're making somewhere between 100 and 150% return on investment per year. Is that better than your mutual fund? Right? So, you know, and on maybe up days, what you do is you buy some more yen pairs, move the stops to break even. And on up days, there are up days. And on down days, you're hedged. Now, on the up days, are you earning pips? Yeah. So you are enjoying that part. But let's say over the course of the year, it's not just 4 trades open. Maybe over the course of the year, you get 8 or even 12 trades open, right? So let's say you get 8 trades going, and that changes this to 300, and you get that, and then you add again to the 4, so now it's 450%, plus the upside on the pips. But yes, you do have to actively hedge on the way down. And if you close the trades before the end of the day, you don't owe interest on your loans, but you're collecting interest on basically the loans you've given to various countries around the world. Isn't that interesting? Yes, Sally Pup, on the amount of your real money that's at risk. So let's just take like a very basic, overgeneralized, not 100% accurate example, right? Like USD yen, you risk 1,000, and you might be able to invest now 100,000 US dollars worth of yen, right? It's not never quite like that, but it's about roughly like that idea. So you have 1,000, but you can borrow either 50,000 or 100,000, or depending on the leverage, more. You're borrowing more, right? So if you are long, let's say New Zealand dollar versus Japanese yen, you take your $1,000 and then you're able to borrow $100,000 worth of Japanese yen. Then you take the $100,000 worth of Japanese yen, and then you convert that to New Zealand dollars and put it into a bank account in New Zealand. Let's just say it pays 2%. Okay? So you're getting paid on the $100,000 in New Zealand. You see what I mean, Sally Pup? Now you might have only invested 1,000 of your dollars, but you've taken your $100,000 or your $1,000, borrowed $100,000 worth of Japanese yen, converted that into New Zealand dollars, and it sits in a bank account being paid the interest. Okay, so now you take that 2% on $100,000, but you only are using 1,000 of your actual real money. That you get that percent, right? So you're earning 2% on 100,000, but you only used 1,000, so you're earning 200%. CFDs don't pay interest. Cash pays interest, Mike. Right? A futures contract doesn't pay interest because it's a derivative. It doesn't. You're not holding the cash. You're holding a futures contract on, right? So if you put 100,000 US dollars in a bank account in New Zealand, you're going to get paid interest because it's cash, because it's literally a bank account. So whatever their deposit rate is, you're going to collect. So it's neat, isn't it, Sally Pup? So I just like to open your mind every once in a while. What if you just built and built and built and built a larger and larger and larger? What if you had $20 million of cash sitting in banks all around the world? You see what I mean? Because what you're doing is you buy a yen pair, okay? It goes up, you move your stop loss to break even. Now you're not risking anything. Now, Sally Pup says it's confusing with banks. Well, that's how I think of it. Like literally, money is going to the Bank of New Zealand, the Reserve Bank of New Zealand, the RBNZ. But you might think of it as a bond. But it's really like a money market, right? And now, but the way I think of it is a bank. You put money into a savings account in a bank pays you interest, right? Yeah, but it's money, right, Sally Pup? It's actually money. So like when you put a trade in on your chart, like TradersWay has to do things, right? Right? And that's literally what's happening, where money goes into the interbanking system, and eventually, somehow, some way, through the magic of through the magic of technology, money is being borrowed and moved around, and it's sitting somewhere. And then if you're buying New Zealand dollars, it's sitting in a bank somewhere in New Zealand, and you're earning a deposit rate just like anyone else depositing money. So, but there are going to be days when you lose, and that's the thing. You don't want to lose if you're holding a lot of money. So, like, let's say your first trade, it's worth $100,000. You move your stop loss to break even. So on day 2, you make another trade, another 100,000. On day 3, another 100,000. On day 4, another 100,000. Right. So over the course of time, you could build up millions and millions and millions of dollars, and yet you're not a millionaire. right? I was teaching my children, we were having this conversation. I said, what if you owned 10 apartment buildings and each apartment building was big enough that it had 100 apartments? So now you have 1,000 people paying you rent. And I said, well, think of it compared to owning 1,000 houses. Because friends of ours own like 7 or 8 houses, you know, and it's a lot of work, right? So I'm like, think of it now, 1,000 different houses have 1,000 different roofs, and the outside needs to be painted every few years on every one of those 1,000 houses. And then you have to pay someone to mow 1,000 lawns. And you got all these problems, but if you own 10 apartment buildings, there's no lawns, right? You don't have to paint the outside if it's all glass. Never have to worry about that, right? And I said, the cool thing is you don't even have to have the money. You just need to borrow money from the bank and say, I want to own a building. And you buy the first building and everyone's paying you rent. And then you pay a little bit of money to the bank and you pay a little bit of money to the insurance company and you pay a little bit of money to the management company. And all of a sudden, you know, hey, you got $100,000 left at the end of the year to pay yourself. And you're like, yeah. Then you go to the bank again and say, hey, I have another opportunity. I would like to buy a second building. It also has 100 people paying rent. You know, and over the course of 10 years, now you got 10 of them, and now you make $1 million a year, and you don't do anything. And it's not even your money, it's the bank's money. Right? Now, Forex can be similar, where wouldn't it be great to control millions of dollars of borrowed money, and you have stop losses on each one protecting you, so there's no downside per se, right? And on situations where you could, the value of your portfolio could fall, right? Your net asset value, right? Your NAV falls. You could hedge that, because isn't that what a hedge fund would do, or a professional trader? You would hedge that, and as long as you don't hold it overnight, you don't pay interest on those loans. So you just sell those yen pairs, and you make money on those positions to offset the losses you've had on your other ones, but you keep the trades open and you're earning interest, right? So Peter says, and then both trade. You know, I prefer two platforms for that, just because stop loss management gets really confusing, right? And I think you should have every yen pair on the planet versus having 10 pound yen trades open. I'd rather you have 10 different yen pairs that you're long, that kind of stuff, and spread things over. And then once you've done that, you know, let's say in month number 2, you're buying dips and redoing all those same. So now you got 2 trades on every single pair over the course of time, and build it as wide and as, you know, and as possible. But, you know, I'm just trying to, one of my goals as your mentor is to get you to look at the market differently from different points of view from time to time, and not just get caught in the video game kind of feel where you sit down every day and you just look for a trade and boom, throw one down on the euro dollar, boom, throw $1 on the, you know, on the pound dollar, and pick up 20 or 30 pips, and that's your day, right? I'd like to show you different aspects of different ways that you could trade this. Um, and if you're like swing trading, for example, you know, your Mondays are going to be busy, and if you catch properly, you're done for the week. Okay. And then if you're going to swing trade, why not swing trade yen pairs? Okay. And if you're going to swing trade yen pairs, why not carry trade them? So you buy and you buy, you move your stop to break even, you're up 150 or 200 pips profit, and your intention is to never, ever, 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 ever get out, right? Because now your goal is to say, well, if if this goes down on this $1,000 I'm risking, you know, I'll earn $1,000 in interest, but still have that cash. And here's the nice thing about Forex, because sometimes, let's say you have a bond, and the bond pays you 5%, okay? And let's say the credit worthiness, the risk on there is moderate and all that kind of stuff. So you're going to get paid 5% every year. If it's a 10-year bond, every year for 10 years. Great. Is it possible that interest rates go up over the course of those years? Okay. Does that mean you're going to get a raise? You're going to earn more on the interest? No. You're stuck. It's fixed at 5%. You're like, what? But that guy over there, he's getting 6%. Kind of sucks, doesn't it? And what happens to the value of your bond now if you want to dump it? Because you're like, I'm earning 5%. I should just dump my bond and buy that one over there for 6%. What happened to the value of your bond? Yeah, nobody wants your stupid 5%. When you can just buy a brand new one for 6, why would you buy some idiot's bond that only pays 5%? You'd be the idiot now, right? So you're like, no, so the value of that bond falls because you're like, hey man, I'll buy you 5% bond, but I can get 6 over here, so you're going to have to lower your prices because I got to pick up my 6% yield, and yield is really a function of price, so you're going to have to lower your price so I can get my effective yield. And you're like, oh man, really? So now you have to sell your $10,000 bond for $9,952. You lose money, right? Yeah, Dre says you can't have, hedge at FXEM. Well, swing on by TradersWay, bro. So anyways, so that's the nice thing about currencies is it's cash, right? So now if banks raise interest rates on deposits, you earn more money. You're like, a raise, woohoo! Boom, 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 boom. Okay. So anyways, and if you've only been trading Forex for a few years, you're going to say, well, these yields are pathetic. Well, the yields used to be ridiculous where, and I've mentioned this before, Google John Taylor. Yeah, where's Taylor? Who did we have? We have a new guy in the room, Taylor, right? So yeah, John Taylor. He ran FX Concepts, the very first foreign exchange hedge fund. Okay. And this guy, for years and years, for decades, paid himself $250 million a year. And the most interesting part of that is their fund generally didn't make any pips. Their goal wasn't to make pips. Isn't that interesting? And when yields fell around the world as they did in the financial crisis, they actually had to shut down. They got killed by redemptions because what happened was their clients were losing money everywhere, maybe not their fund, but just everywhere else. So what happens when you're an endowment and all of a sudden you're losing hundreds of millions of dollars because all the other equity hedge funds are losing money because the equities are falling, right? So that all of a sudden they're redeeming money from everywhere, just going to cash and just like, give me my money, give me my money. And so they got killed on that side, but also interest rates fell everywhere, didn't they? To like zero. And they couldn't earn any money anymore, even if they were hedged. So what I'm trying to tell you is that there are funds that do exactly what I was discussing with you today. And if you think, because of your leverage, 15% a year or 150% a year, if you think that's an amazing, go back to the time when the differential between New Zealand dollar and Japanese yen was 8%, because now we're talking 800%. There was a time because you were leveraged, you could make 1,000% return on investment per year and not make any pips. Not even make pips, just interest rate payments, right? Yeah, like ridiculous, right? Like, so, so that is a business model you can apply to the foreign exchange market. Or you can just try to make, you can brag to your buddies, I made 37 pips today, woohoo! But you'll just never get filthy stinking rich doing that, right? So, Sally, is it still possible? Well, the yield differentials are low, right? New Zealand dollar, what is it, 1.75, right? Or is it 2? Something like right in there, right? Is it still 225? All right, so it's 225, right? So the Kiwi yen should pay 225 because you're right, the Kiwi yen, because the Japanese yen is essentially free. So let's just say nothing's free, right? So let's say you're clearing 2%. Good. But if you're leveraged 100 to 1, now you're making 200% a year. Right? So that's all. So again, now if you're making 200% annually on your interest, what's the next goal? What's the secret to success? Asset under management times compound interest. So think of it though, now you want to control millions, tens of millions, right? Right? Which is amazing, right? In Forex, you can trade hundreds and hundreds and hundreds of millions of dollars. It's right. It's great. Yeah. Oh, yeah. So you get paid interest 5 p.m. at rollover. It's called. You get paid every single day. Okay. If you're short Japanese yen pairs, you're going to earn a negative differential and you're going to have to pay the broker. If you're long the Japanese yen pairs, meaning you're short Japanese yen, long whatever else, so you're borrowing the yen and buying something, you're going to earn interest. So that's why you want to have one account where you just long all Japanese yen pairs with stops at break even on each, so you're not actually risking anything. And then the other one, right? All you're going to do is buy Japanese, or in this case, sell Japanese yen pairs, but you're not going to hold them past rollover, because if you hold them past rollover, you're going to have to pay interest, which offsets the interest payments you collected that day, which makes the whole thing pointless if you do that. Now, the thing is, all you have to do is close your trade 1 minute before rollover, and then 1 minute later, you can get back in if you want. And you just skip the whole, okay? But you have to actually do that. Sally Pup, because every day the hedge is, what you're doing is hedging the amount of money you lost. So let's say you lost $1,000 on your yen pairs that are long because the Japanese yen pairs came down that day. So the idea is now you need to sell Japanese yen pairs in your selling account or your hedging account. So you make $1,000 here and you lost $1,000 here, so nothing happened, but you still want to collect the interest payment. But if you're hedged over the rollover, you're also now going to lose money on the interest, because now you have to pay interest on the hedge, and you earned interest on the non-hedge, right, on the actual investment. And now you didn't make any money in pips and you didn't make any money in interest. What you want to do is know every single day, no matter what happens, you're going to collect interest payments. Okay? And if you don't have them, if you don't have it hedged, what will happen is you'll just lose $1,000 that day, but pick up your $22 in interest payments. Well, you don't want to lose $1,000 in a day for the opportunity to collect $22, do you? No. The trades have to be open 24 hours to collect the interest payment. So you have to be long-term long. And then short-term short, only on days, by the way, only on days when the yen pairs are falling. On days when they're not falling, you either add to your long positions or don't do anything at all. Because now, let's say, because the yen pairs aren't falling, let's say they all go up 100 pips. And you're long 4 trades. Well, you just made 400 pips. Then the next day, the yen pairs pull back 50 pips each. So you sell, and collect as much pips as possible to offset the losses in your long position. And then it was just a retracement, and then it extends back up. And once again, you make 400 pips on day 3. But on day 1 and day 2 and day 3, you collected your interest rate payments. Okay. Now again, it might only be $22, right? Depending on, but that's $22 times almost 400 days, right? Dan says, so when you're heading, it's more technical day. Yeah. So like, let's say I was long Kiwi yen from 3 weeks ago. Okay, so we're long here. Okay. Okay. Let's just say, I remember actually doing this for you guys, right? Okay. Great. So we're long down here. It's 72. Well, we're at 75 right now. Okay. So we're up 300 pips. Cool. But we don't even really care about that. On the long run, we expect to make 2,000 pips, right? So who cares about being up 300? It's not the point right now. It's not even interesting. But what if the yen pairs come down today? Yeah, so that would be a technical day trading strategy, selling off the weekly central, because it's clearly made a trade, right? It's a lower low, lower high, role reversal scenario, right? So you're like, oh, well, I have to take this. And it's truly a hedge, because you know if this falls 50 pips again, so back down to here, you make 50 pips on this account. And you're like, yay, I made 50 pips. But you lost 50 pips on the other one because you're long, so you were 300 pips profitable, but at the end of the day, it turns out now you're only up, 250 pips profitable. But you're going to collect the interest. Okay? So, back in the day, I knew people like just average Joe new traders, just like you. I knew people that were emailing me and they're like, oh my God, I'm making and it was ridiculous. These guys were making like $1,000 or $2,000 or $3,000 a day on interest payments. They're freaking out. They're like, this is more money I've ever made in my entire life. Oh my God. But they were leveraged to the yin yang. This is way back in the day where, Americans could be leveraged 500 to 1 if they wanted to be. And the interest rate differentials were huge, like we're talking 6 and 7 and 8% spreads. And so these guys are just leveraging up and just, a guy that's got like $10,000 or $15,000 in his account suddenly is controlling $1 billion. And you're like, what? Yeah. This is so long ago. I also remember around this time, because everyone was long pound yen, right? And then guess what? The yen pairs collapsed. The carry trade collapsed, and there was no other side of the market. I remember it. It was great. And one of the brokers just stopped trading, right? Because they had, like, no joke, they had like $3 billion long pound yen, because that's what the clients were doing, and this is back before ECNs. So their brokers were basically market makers. So like this one broker was long like $3 billion in pound yen trades, all because that's what their clients were doing. Everybody was doing it, right? And then the yen pairs collapsed, and so somebody had to, like, yeah, take the opposite side of your trade. Except everyone was doing the same trade down, right? There was no opposite side. There was no opposite market, right? So, anyways, this broker, I think it was called One World, stopped working. It just, like, clients are like, get me out of this, get me out, and they're not executing any trades, and just nothing was happening. So finally, I think it was the NFA. Finally, they get all these complaints, but from hundreds of clients, that this One World is just uh, not executing trades. So the NFA goes to the address, right? And guess where the broker was? They just show up to the broker's offices, like, to check them out, to make sure everything's good, to audit them, to see, like, why aren't they clearing their clients' trades? And guess what? It was a dormitory at a university. They were running it out of their dorm room. This was back in the wild, wild west. Now, I think now you need, what, $20 million to be a broker, just in cash. So anyways, but it was pretty funny. That was me. Yeah, not. But yeah, those college kids must have been freaking out, huh? Like, they must have just been making money hand over fist, and then it was just all gone because the market collapsed, and everyone was getting out of these, unwinding their yen positions, and there was no market yet. Back then, like I said, a broker was a market maker, which means if you bought pound yen, they had to sell it to you. They were on the other side of the trade, right? Now, most of the time, this was a great business because 95% of new traders are throw their money away doing stupid things, right? So think of it. Clients come to you, put $5,000 in a trading account, and they make every stupid, embarrassing, pathetic trade you could possibly do, but they do it 10 or 15 times in a row, right? And they blow up their trade account. So if you're on the other side of that, you're like, this is great. People open up trade accounts and they're stupid. And they throw their money away doing stupid things. Like, they don't even know how to trade, and they're just throwing down all these trades. Woo! And it would have been a great business, right? Because you knew at least 95% of the time, probably even more, someone would deposit 5,000 into their Forex account and then blow it up. And you didn't even have to do anything, because a broker would think, oh, this money is just going to go to my bank account, because you're on the other side of the trade. They're going to throw it away, which means they're just throwing it at you. And you're like, yeah, this is great, right? Better than a casino, right? But then you could see now the risks. What if all your clients are long, and now you're sitting there like, oh my gosh, if I have to pay them money. Whoops, right? And all of a sudden, what if your clients are long $3 billion in pound Japanese yen trades, and all of a sudden they're like, all right, I need to cash out now. They're like, you can't cash out. So that's where they were stuck. So when you look at, like, TradersWay, going through Brexit, going through the Swiss debacle of a year or two ago, all these times when the market died and brokers almost blew up, TradersWay has just been absolutely totally fine, because they're not playing the other side of your trade, right? And in the old days too, I remember talking to one guy who's quite famous. He's one of the guys you see on TV. No, not that guy, a different guy. I was talking with him because he worked with one of the earliest brokers before really there was even retail Forex brokers. And uh, he was telling me a story about when the senior trader came out onto their their little trading floor in the bank or at the broker, right? The senior trader comes in right before non-farm payrolls, and the head trader says, "All right, none of our clients make money today." What? And apparently stuff like that happened. Boom. You're like, whoa. What do you mean? They would find a way that every single one of their client, and the broker would just make, millions of dollars that day because they're just going to find a way for everybody. And then there was a time I was exploring arbitrage. Do you guys know arbitrage? This is where you trade brokers against each other. And so there was a time like during non-payrolls when volatility was really crazy high. I had 4 different broker platforms up, right? Yeah, Jim, by the way, Jim, they courted me. PFG Best, they courted me for about a year to join them. And their paperwork bothered me a lot. I minored in law in college, right? So I'm reading the contract. I'm like, this is really odd and strange stuff. I'm like, I don't feel comfortable with this. That just doesn't feel right. So I'm like, no, I'm not gonna work with you guys. And like 6 months later, yeah, it turns out they were a bunch of scumbag scam artists and blew themselves up. And I was very lucky because they courted me hard. I mean, they said all the right things and brought flowers and chocolates, told me I was pretty. And I'm like, ooh. But I don't know. This doesn't look right. Doesn't feel right. So I backed off, and turned out it was the right thing. But anyway, so I had 4 brokers open. And this must have been, I don't know, 2005 or something, right? It was way back in the old days when it basically wasn't regulated at all. Now it's way overhead regulated. But it was interesting where non-farm payrolls came out. Broker 1, big green candle. Broker 2, big green candle. Broker 3, big green candle. Broker 4, big red candle. What? So that broker was throwing down a red candle to get all their clients to sell, and then 1 minute later would fit and go green back to the market, and of course every one of their clients would have lost. And after non-farm payrolls, especially back then, if you got like 300 or 400 of your clients to suddenly just very quickly sell the euro dollar, and then 1 or 2 minutes later, each one of them lost 150 pips each times 400 people. That was back in the day. Those weird, terrible, unscrupulous, scary days. No, thanks, guys. Yeah, I guess I need to be careful because I'm going from memory. You guys are Googling stuff, PFG Best and One World and all that kind of stuff. So I hope I get all the names right. It's been a very, very, very long time. But the funny thing is, I was around during all these times. And so, anyways, there was a while I was testing this theory where you'd watch like a news event come out, like CPI or ISM or NFP, and you would see green, 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 red. So you would buy the red one, knowing that either they're purposely manipulating the market, or maybe back then technology wasn't that great, so they had a bad server. It just was, or their internet connection was a little bit slower, or they didn't have a good interbank system, so they were not getting efficient pricing, compared to the other guys. So you get this red candle, knowing that the market's green. They're like, oh, they're on the wrong side, right? Right? So anyway, you'd buy the red candle knowing they're wrong. Those were the days. So luckily, we're in a balanced, harmonic. Where times are good. You don't have to, you don't have the craziness. So, like I said, even through Brexit and the Swiss debacle, those are probably the biggest things that have happened in the year and a half or so that I've been with TradersWay, and their platform's been smooth and flawless, you know. And I'm not just saying that. I mean, if it was choppy or had frozen, I would mention that, and I'd probably explain why, and I'd say, oh, well, that's the interbanking system, and it's not the broker, it's just the other side, and if J.P. Morgan and Deutsche Bank don't want to trade during those times, it has nothing to do with TradersWay. They're just entering your trade into the interbanking system, right? But actually, I don't even have to explain that there wasn't any problems. I'm like, I traded right through the heat of both those situations, and not a problem. So yeah, so nice to know. So hey, so I'm sorry I babbled on today. Yeah, I think. I think I got off track big time today, so I apologize for that. But maybe I got yeah. I mean, it's a fairly quiet time of the year, so maybe that's just what's happened. But I'll be here tomorrow. So if I didn't do enough technical analysis, I really do apologize, and I can do more tomorrow if you want. But yeah, but you inspire me. What do I mean by funding currency? So Piper, if you buy something in Forex, you have to sell something else. So in my example of buying Kiwi yen, my account is in US dollars. Okay, so here's the process. With the 100,000 US dollars as collateral, or margin, if you will, but just think of it as collateral. I pony up the $1,000 and borrow $100,000 because it's leveraged worth of Japanese yen at that whatever that exchange rate is, right? So at 106. Cool. So now I have 100, 106 times 100,000. Okay. So now that's how much Japanese yen I have. I used 1,000. I leveraged up, so now I control 100,000 US dollars, and then with the 100,000 US dollars, I convert that into Japanese yen at that exchange rate. Okay, great. So now I own $100,000 worth of Japanese yen, and then I convert that into New Zealand dollars. So I've borrowed, okay? I've borrowed $100,000 worth of Japanese yen. I borrowed it, okay? I owe interest on that. It's like a loan, and I'm using my cash as collateral, okay? So now I owe that. That's that, right? And then I take that and I buy New Zealand dollars with it, okay? And I'm funding that with the Japanese yen. So the Japanese yen, when I'm long, Kiwi yen, the funding currency is Japanese yen, and I've invested now into New Zealand dollar. New Zealand dollar, every single day, New Zealand will pay me 2.25% interest rates. That's an annual rate, so divided by 365. But every single day, I have to pay interest. Or no, sorry. Every single day, I earn interest on the New Zealand dollar, 2.25 annualized. And I owe on my loan. I borrowed Japanese yen. So I'm funding the purchase of New Zealand dollars with my Japanese yen. Now, I have to pay that loan every single day too. Just happens to be that that loan is zero. But you have to do the calculations, right? So let's say it's zero. If it was 0.25, which was that's what the interest rate was for a very, very long time, I would earn 2.25 in New Zealand would pay 2.25 it, right? And I would have to then pay Japanese yen at 0.25. The difference is 2%. So I'd earn the 2%, right? But the 2% is on the $100,000, not the 1,000 I've used as margin. So that's where you get the 200% because it's 2% on the $100,000. I've only invested 1,000, right? So at the end of the year, I'd earned $2,000 in interest payments, and I've only ponied up $1,000 in cash. So at the end of the year, if I made no pips, I would have $3,000. Okay. So now Joseph is saying, well, it's basically zero, right? So that's how you do that, right? So you use your 100,000 as your collateral or margin. You leverage that up, you borrow something, and then you make your investment. So you could borrow Swiss franc and take the Swiss franc and invest it into New Zealand if you wanted. Okay. And in fact, what I would do is I'd buy all the yen pairs, and then I would say, okay, I got the yens. Now, because again, I want to keep all the trade and the portfolio as clean as possible, I might look at other funding currencies and say, okay, I own 5 or 6 or 7 different yen pairs, and they're all long, stops at break even on everyone, have no actual risk. So therefore, now I'm going to repeat the process, but I'm going to repeat it against Swiss franc. So I'm going to fund the portfolio with Swiss franc and start looking at, pound Swissy, euro Swissy, Kiwi Swissy, Aussie Swissy, and you start building all those, right? So I'm just trying to get you to see it from a different point of view. And the point of that is going to be income. Now, if you play it right, though, on all the days the yen is strong, you're going to hedge. And on all the days that yen is weak, you're not going to do anything, but you're going to make pips, right? So at the end of the day, you might earn 200% in interest payments on your leveraged money, right? Or no, 2% on your leveraged money, 200% on your actual money. But you might earn 1,000 pips by the end of the year. Right? And the 1,000 pips could be significantly more valuable than your interest payments. Because on those days you're not hedging, you're letting it run. You're only hedging on days it's coming down. You don't want to have a true hedge where you're long and short at the same time, because you don't make any pips, but then you don't clear any interest payments either, right? You see what I mean? Because you'll on your long positions you'll earn 2.25%, and on your short positions you'll have to pay 2.25%. So you don't make any money. So I just want to make sure that's clear. That's why you're short-term short on your hedges, and you're long-term long on your investments. Does that make sense? You can't hold your short trades overnight. Otherwise, you'll have to pay interest. Because now you're borrowing New Zealand dollars at 2.25% and buying Japanese yen. Well, you don't want to pay 2.25, right? So that's why you got to be short-term short, so you never pay interest on your loans. And then you always want to be long-term long, so that you always have interest income. It's a beautiful thing if you think about it, isn't it? So what'll happen is the secret to success is going to be assets under management, or even how much you're trading. No. The carry trades, no. July, I rebuild. July and August are rebuilding months. Okay, and on January 1st, I'll unwind. Okay. But I don't know. right? Not fiscal, calendar. Yeah. January 1st, I'll dump, and I'll probably buy Japanese yen. But anyways, I gotta go. I'm sorry, I got off track today, but I thought maybe it was interesting, and hopefully it all works out. Did you say build in July and close in Jan? Yes, yes, that's exactly right. Now, why would I do that, Sally Pup? Why would I sell in January? Taxes. Yeah. So now I have to pay taxes on my profits in 18 months, not 4 months. Sneaky, yeah, Peter, right? Yeah, have the evil plan. Yeah. No, but that's the point, and that's why everybody else does it too. Some hedge funds will dump just before because they want to book at year end and say in 2016 I had a huge year. But if they're losing, they'll defer that. And then others want to pay the taxes later. Defer. Right? So imagine if you sold your trades on December 31st, you owe taxes in April. Okay? 4 months, right? If you sell January 1st, you owe taxes in April, not in the new year, but in the following year. So it's 18 months versus 4 months. And when do you want to have to pay that? Soon or way off in the distance? Okay. Yeah. So anyways, peace on earth. May the pips be with you. May our profits be above average. I'll see you tomorrow. Bye.